Welcome to the deep dive video. This video is designed to go over the charts that I probably didn't talk about at all or very much in the past week. Sometimes we can still get some insight by looking at these charts even though they're not necessarily telling us anything blatant at this present time. This is being prepared for Monday, February 6th. The first chart we look at is the VIX, which we've been talking a lot about, but on the bottom we have an RSI 9 period plotted. We really only pay attention to this when it gets extreme positive or extreme negative. Now, the VIX goes the opposite way of a lot of logic. When the market's going down, the VIX tends to go up and vice versa. So when we're getting a real low reading, that means the market's really been going up. Even though the VIX has been coming down and it's below 20, which is a static number that a lot of people use to determine whether fear is rising or declining, when we drop down to this low level, that means there's a lot of complacency in the market. And when it really goes down low, that's when the RSI tends to drop. This indicator can be useful when the VIX is going down, but we usually use it when the VIX is really going up because that produces a lot of fear and big spikes in the VIX can happen. Another thing to look at is just where are we at in relation to the all-time high. Right now, we're down 14.16% from the all-time high set in January of 2022. Looking at some different support and resistance charts, we did use this Ichimoku cloud a lot when we were going sideways and the S&P 500 was building a base at the end of 2022 and the beginning of 2023. But since then, we've been climbing above that level, and this chart is looking more positive, but not necessarily telling us anything right now. Some technical alerts. I go to stockcharts.com. I look at the technical alerts each day. These are just the alerts for Friday's session. You typically read these from the bottom up because if you look over on the right-hand side, we have the timestamp. A lot of the alerts that were triggered on Friday had to do with the NASDAQ, where it went below 12.2, 12.1, 12,000. The Dow fell below 34,000. The consumer staples also are seeing some recent strength where their BPI crossed above 50, and that generates a signal. Above 50 is positive, below 50 is considered negative. Oil, which has been dropping lately, it crossed below 75, and then gold, which had been seeing some real strength, declined in Friday's session to below 1900. Another thing that I like to look at are the 5 main indexes that we watch: the Dow, the S&P, the NASDAQ 100, the small caps, and the mid caps. This chart rates things on a scale of 0 to 100. The closer we get to 100, the better the technical chart is looking. In first place are the small caps at 92.2. In second place are the mid caps at 92. And then here's a historical chart to show you how this has changed. Third place, coming in just a few weeks ago in the single digits below 10, the QQQs, which are tied to the NASDAQ 100, it has really been improving a lot lately at 59.2. The next one is the S&P 500, the one that we focus on. It comes in at 53.8. And the diamonds, which are based on the Dow, came in at 44.2. When we really take notice of these rankings is when they're 90 or above. That just shows that it's a much more healthy looking technical chart. Some short-term charts to show you. We have the 10 through the 50 period simple moving average. This is a rainbow. And when everything is underneath and the market is going up, that signals a really strong uptrend. Well, we've been bouncing around a lot in 2022. We're starting to break above the rainbow right now. And as we're above all the different moving averages, this will help to smooth out the moving averages so that they stay underneath price. Now, if we turn and go back down, this will turn into a jumbled mess again. Intermediate term charts. This is a chart that I created a while back. It just takes a 20 period simple moving average of the open, and then another one of the high, the low, and the close, and just plots them because sometimes these can act as support when we're going up and seeing a pullback. Other times when we're going down, they may act as resistance somewhere along the way. Another chart is standard deviation. How far are we getting away from the standard or average price over a period of time? I also plot a moving average. When we're below this moving average, it just shows that price is not moving all that much. When we go above it, that means that the market is moving rather quickly. The parabolic SAR system, when the dots are on top, that's negative. When the dots are below, that's positive. Since the early part of January, we've had a parabolic SAR with the dots underneath, and that is confirmed by the uptrend that we've been seeing. The mass index is not generating a signal right now. When this goes above the dashed line and then above the blue line, that's signal number 1. Then when it drops back down below the dashed red line, that is signal number 2. Whatever is happening at that time, we look for a move in the opposite direction. This is a double and triple exponential moving average chart. That's the red and the blue lines here, showing that we are in an overall uptrend. What I've been paying a lot of attention to lately is this anchored moving average back to the all-time high, and this had been acting as resistance as we've been trying to go back up. Well, we were able to break through that this past week, and now if the market comes back down, we'll see if this ends up acting as support. Connors RSI is just a variation of the RSI. We look for extreme positive or negative readings, which we're not really reading one now. When we're below this dashed line, that's more negative. When we're above, that's positive. With Friday's decline, we saw the Connors RSI drop below the dashed line. Here's an intermediate term rainbow showing 50 period through 100 period moving averages. This moves a little slower than the short term rainbow, but we're looking for pretty much the same thing. Are these moving averages smoothed out, or are they jumping all over the place? Because the market was so jumpy in 2022, I didn't use these charts an awful lot. I would rely on them heavily when we were going up back in 2020 and into 2021. We want to keep an eye on volume in a good, healthy environment, whether we're going up or down. We want to see an increase in volume. When we see an up move on lower volume, that's a warning sign. When we see a down move on lower volume, that's also a warning sign. Lately, we've seen volume really starting to pick up, so the red line and the black line continue to advance, and then there's a histogram here, also measuring how volume is doing. The vortex measures buying, that's the green line, or selling, that's the red line. When the green line's on top, that's more positive. If we see a switch where the red line goes on top, that is more negative. The ease of movement, just looking back one day, this suggests what is the path of least resistance for a move in the S&P 500. When this drops below, that means it's not moving very easily. What I look at more is a 14 period. When we're above the dashed line, that's more positive. When we're below the dashed line, that's more negative. The money flow index acts just like any other oscillator. We look for an extreme above 80 or below 20. If we're above 50, that's positive. We're positive right now, but we did see a decline in the money flow index. The advanced decline ratio takes a 19-period exponential moving average and also plots a 39-period exponential moving average. The blue line moves a lot faster. That gives us an idea of what's happening with the advanced decline line. The red line's a little bit slower, and when they're both moving in the same direction, that produces more of a conviction. All of our oscillators are currently positive. The one we've been watching lately is slope, so I've been pulling out a separate chart just for that. But the TSI is also going up. That's another short-term oscillator. In the intermediate term, we look at the MACD, the PMO, and the PPO. Those continue to be positive. Our longer-term oscillators are the TRIX and the KST, and those are also continuing to advance. The balance of power, when we're above the dashed line, that's positive. When we're below, that's negative. We're above right now, but have been seeing some recent declines. This simply measures how far away are we from the 200-day simple moving average. We spent most of 2022 being below the 200-day simple moving average, but recently we've been able to break above that. The PMO is one of the oscillators that we follow. That's plotted here in the top part. Well, we also have some additional studies that apply to the PMO. This is based on price and volume, and they're both continuing to advance. Sometimes these can give us a little bit of a heads up. If you notice in this chart, the crossover on price and volume happened before we saw the crossover with the PMO. So that gave us a little heads up that the trend was actually turning. The ultimate oscillator, again, looking for extremes above 70 or below 30. When we're above the dashed line, that's positive. We're coming off of a recent extreme positive reading before seeing a decline, but the ultimate oscillator is still positive. Praying bottom fisher, this generated a signal back in the early part of January. That was confirmed by other charts that we look at. Since we've been going up, chopping around a little bit, the Pring bottom fissure has been going away. And this, as the name suggests, is really good at finding bottoms and then turning back up. It doesn't necessarily tell us when we've hit a top. Looking at some different charts, the Heiken Ashi continues to be positive with a lot of open candles. The Kegi chart is also positive with black bars going up higher. The Renko has open blocks, which is positive. The 3-line break also open candles, positive. Point and figure chart, we did look at this earlier in the week, but I just wanted to bring this back up, where we're looking at a triple top breakout that was generated after Thursday's session on February 2nd. This is looking more positive. We see the blue line underneath, which is marking an uptrend. Some different trading systems. I do show the Elder Impulse system quite often in the videos. Another system that I don't use as much is called the Go, No-Go system. When we get a go, that means the bars are blue, and those are signaling buy signals according to this system. When they turn light purple or dark purple, that is suggesting that you get out of any long positions. Currently, we're looking more positive. We have blue bars here after generating a go signal. Some long-term charts. Here's a longer-term rainbow going from 50 periods all the way up to 250 periods. This moves a lot slower, so it's picking up more of the downtrend that we saw in 2022. We've been able to get back above all these moving averages, but we need to stay above this for all the moving averages to turn back positive and look more like they were in 2021. Special K, another really long-term oscillator that we use. It's still negative overall, and it crossed over negative at the early part of 2022. It's trying to bounce right here, but it has not crossed back above the moving average yet. This is a brand new chart, and I would have included this in the daily video. What I do after Friday's close, I do everything I can to try to get the video out onto YouTube and Rumble just as quickly as possible. Then I kind of sit back and look at different charts. I get a chance to play around with some things. I do some research. I came across this as I noticed from the all-time high. It looks like we set the low back in October. So I did a fib retracement here, and we are now bumping into a 50% retracement with the S&P 500. That could provide some significant overhead resistance. We're also seeing that on other charts as well, and they're kind of converging with each other. And that's why we may see a bit of a pullback in addition to being short-term overbought or kind of extended as the market was really going up. But I will be including this often in the daily video updates as long as this chart is applicable. Also, we want to look at the NASDAQ 100 from the all-time high back to the October low. We're coming up to the 38.2% retracement. So we're seeing a lot of indexes, major indexes, converge at the same time by hitting overhead resistance at the same time being overbought. And that generally suggests that things could turn negative to chop sideways for a while. If we do turn negative, we're going to be watching what happens. Is that going to change the technical picture and switch it back more negative? Or are we just resting before we're getting set to go even higher? Here's another long-term weekly chart looking at Fibonacci levels. This is measured from the COVID low to the all-time high. We're well above this 38.2% retracement level, and we're well above this 200-week moving average. So this is staying more intact longer term. Another newer chart takes a ratio between the S&P 500 and the Dow Jones Global Index. When this is going up, that means the S&P 500 is outperforming. Well, recently, we've been coming back down to this moving average. We've been turning back up, and that could be positive. However, down at the bottom, it's looking a little more negative because the KST hasn't crossed back over positive yet. Both the blue line and the red line down below are right on top of each other and still having a tendency to go lower. So that could be negative. We'll be keeping an eye on this chart just to see if we bounce back up or if we break through to the downside. Some broad market things to look at. This is the Vixen, which is the VIX that is applied to the NASDAQ 100. As the VIX has been getting a lot lower, so has the Vixen. It's really been chopping more or less sideways. There's some erroneous data on this chart, so it looks like icicles are hanging down here. What's a little more clear is the line chart, which just plots the closing values and shows how volatility has really been decreasing, although in Friday's session it did pick up slightly. Some bond charts. This chart I also brought up a week or so ago. This is an attempt to measure fear. When we're going down, that means fear is lessening. That's why I have a blue line here. When it's going up, that means fear is increasing. So we want to look at this similar to how we would look at the VIX. The only problem with this chart is we've been really decreasing as far as fear is concerned throughout 2022. Well, 2022 was a pretty crazy year, and so this isn't really picking up a lot of the movement that we're seeing. We did get some look at this back when we hit the high back in the spring, and then over the summer, and then into the fall. It's just not as pronounced on this chart when you compare it to what happened during the whole COVID plunge. This measures shorter-term bonds against the S&P 500 equal weight ratio, where every stock is given the same amount of weight, unlike the S&P 500, which is a weighted index, so the big companies have more of an influence. Some rate of change charts, I don't have all of them here, just the longer-term ones. The 250 period, after coming down to the COVID low and turning back up, is showing some improvement. Here's a longer-term look at that same chart. We did go down and test the COVID low before bouncing up. Well, back in 2008 into 2009, we went a lot lower than this. The inverted yield curves, I don't have all the charts individually to show you, even though I plot those. I just wanted to include all of them on this chart, where all of the yield curves that are plotted here, the 10 to the 2, the 10 to the 3 month, the 30 to the 5, that had bounced back and gone normal for a couple of days, and now it's back to being inverted. The 10 to the 5. On the bottom, we have the 10-year to the Fed funds rate. The only problem is the Fed funds rate data is not updated all that often, so it doesn't make this all that useful, but the other areas of this chart are pretty useful. Looking at some of our possible positive scenarios, those stocks that are above their 200-day simple moving average, we had a double bottom here back in October, and we've been going up, and you can see the arrow. That's where we're currently at. We're not as excited about this signal because we came up out of that. This is meant to be more when a climax occurs in the market. We came up, bounced around quite a bit, and now we're starting to break a little bit higher. So now we use this more like an oscillator. If we continue to go up, if we get extreme positive, that'll be a warning sign. But for right now, it's just telling us the general overall direction and not necessarily giving us any kind of a powerful signal. You could go all the way back to October and say that was the signal. We have other charts that are also telling us that, but all this jumping around doesn't make it as viable. Those stocks that are above their 50-period moving average continue to advance, also became really extreme negative back in October, almost got to extreme positive before falling back, and now have been showing some improvement. The mid-caps above their 50-period exponential moving average, they are looking a little extreme, and the mid-caps are one of the better looking charts right now, so it's no surprise that they're starting to get extreme positive and showing a lot of positive thrust. And then the small caps also not quite at an extreme positive reading, but after giving us a low back in October, has been showing a lot of improvement, but a lot of bouncing around in between. Thank you. I hope you found this useful. I hope this fills in the gap between the charts that I show in the other videos, especially the daily video, and give you a little bit more insight to what is happening. I hope you have a great week, and I will talk to you in the next video.